FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is 9/23/20. Well, if you've been watching, we've seen a pullback in the metals. To be expected. Things were getting a bit speculative. Prices were just going higher and higher. You saw companies go up 5 and 10-fold, literally in a matter of weeks. And when you see that kind of movement, there's a certain inevitability to it. But how long will the consolidation or the pullback last? What will it go down to? I'd like to get your opinion. Why don't you send me an email at kl@kerrylutz.com. Right now, we got a treat in store. We've got Jordan Roy Byrne. You know him well from thedailygold.com. And Jordan, it's great to have you back on. So, hey, your book, The Coming New Bull Market in Gold, was kind of prescient, wasn't it?
Yeah, I guess it was. I mean, I wanted to do it. I think I published it last May, and I did do a little bit of an update a couple months ago. And when I published it last May, I wasn't sure for the next cycle, like how it would play out exactly. But at that point, the big thing I was following was historically, whenever the Fed shifts their policy and they move from basically hikes to a pause, and then they do the first cut. Gold stocks had always had a spectacular move higher, and I use gold stocks because we can go back before 1971. There's a lot of good data there. And so when I was writing the book, that's really what I was focused on. But I wasn't exactly sure because we weren't in a recession at that point. I mean, the economy was soft, but we weren't in a recession. And it was, the future is always uncertain, but at that point it was uncertain. What will the next recession be like? What's going to happen coming out of that? And so that was kind of unclear. But with that said, now, Kerry, that's a lot more clear because, interestingly, we did hit a recession, at least the people who track it, they said in February. So that was even before at least COVID stateside, but I don't know if some of that was inspired by COVID in China, probably. But I mean, it'll be known as the COVID recession. And, coming out of this, we're seeing a lot of policy changes that are going to be inflationary down the road. I'll just touch on a few of those. We have policy now in corporations. They're going to be increasingly less reliant on China. There's going to be, there'll probably be more regional trade than global trade. And so that kind of, more moving production back stateside, if that's possible, that type of policy is more inflationary. And then at the same time, we're hearing about things like UBI and, possibly the Fed, instead of, they are doing QE, but maybe the QE will finance government spending and infrastructure projects and those sort of things. So all of those things are more inflationary. I think we've talked about this before, yes. How this cycle we're going to see, policymakers, they have to get money in the hands of the people. It doesn't really matter if you lean left or right. The majority of the country wants that. And, so I think, regardless of where politics trend over the years ahead, we're going to see more money hitting the hands of the people. That's more inflationary. So if you look at those factors, and then we have commodity prices, which, they could be emerging from a major bottom. So I think over the years ahead and over the next 10 to 15 years, we're getting into a new commodity cycle. So all of these reasons portend to a secular change in inflation moving forward. We haven't quite seen that in interest rates yet, but that'll probably be the last driver of that. So in the very big picture, we're seeing shifts that are going to be positive for precious metals and hard assets. I don't think just for this cycle, but I think for years to come. And with respect to this cycle, this cycle, it could be similar to the way it's kind of started in the rocket rebound we've had is a lot like 2008. But I think with respect to this economic cycle. It's more similar to the early 2000s or maybe even the 1930s. I mean, there's some similarity to that cycle we had in the early mid 1960s. So I know that's a mouthful there, but that's kind of how I see where we are here and now. I mean, those cycles, I think, they have some similarities to what we can expect over the next few years. But with that being said, in the very big picture, looking out over the next decade or two, I think the conditions are definitely favorable for precious metals and hard assets.
Yeah, I think you are probably correct in that assertion. And so when we look at it and when we're looking at the markets, we've had some tip-offs about what was ahead before. What tip-off do you think we're going to get next?
That's a really good question. I'm right now, I'm more in tune with the charts. I mean, I'm always looking for fundamental developments. I mean, it's hard to say. I know some people have talked about a new stimulus deal that could lead to the next move higher. But I mean, looking at the technicals, I mean, they tell me that the path of least resistance in the short term is lower. But then we could, once we kind of finish this correction, and we do have to go lower, but once that ends, we could go much, much higher after that. I mean, I'll just mention, we talked about it beforehand, but there's two other points in history where gold made a new all-time high after following a legitimate bear market. And those times were 1978, then at the end of 2009, going into 2010. And after those moves, Kerry, both those times, gold was down. Gold corrected. One time it corrected 20%. The other time it corrected 15%. Both those times it bottomed at the 200-day moving average. So if we're looking at 15% correction is going to put gold, I think, in the high 1700s. I mean, gold has just broken 1920, so I see it falling to the low 1800s at least. But look, even if we test the upper 1700s, we get close to the 200-day, we register a 15% correction. That's nothing to worry about because this has happened before in history. And if I look at those 2 points in history that had those corrections and what happened after those corrections, and I take the one that had the softer move after the correction, that still projects a 2,600 gold price January 2022. So that's like 15 or 16 months from where we are right now. I mean, that's a heck of a price considering, we're at the low 1900s right now. So this correction is really nothing to be worried about. It's just going to set the stage for the next leg higher. And look, you can't go higher every day, every week, every month. We had a tremendous move in a little more than 4 months, got extremely overbought. It's going to take a little time to digest that. But with respect to the damage in price, Kerry, these price corrections, they tend to not last that long. So I think we're like about 6 weeks right now. I mean, looking at history in those 2 moves, those corrections were 2 months at the most. So what we could see, I think we'll see lower prices over the next couple of weeks, the next month or so. We'll make a price low, and then the market will build a base, grind higher, and eventually, retest and take out the high. So that's kind of what I'm anticipating. It's still not time to jump back in yet, but if we're patient, we wait a few more weeks, I think we're going to see lower prices and a very good lower risk entry point.
But if you're the impatient type and you did jump in, how badly you think you could get burned here?
I mean, it depends exactly where you jumped in or, which type of stocks you have. I mean, GDX, we're trading in the mid 39s. I mean, it could go to 37, maybe 36. GDXJ, the juniors, that setup's a little bit cleaner. It has really strong support around 50, 51. So that's trading in the high 56s right now. So, roughly, generally speaking, maybe another 10%. And look, if you're happy with what you bought, it's a good company with good fundamentals. You don't want to get jumped out just because it might decline 10 or 15%. I mean, you get yourself into trouble when you're trying to trade in or trade out. I mean, if you're in the right company, and you didn't buy at the exact top, just hold on to that and let the market help that investment eventually turn around and move higher. Now, I wouldn't do that in every case. I mean, you have to know that you bought the right company and you really have to know what you're doing. But generally speaking, looking at GDXJ, I don't see that much more than 10% downside from here. So, prepare for a little bit more downside, but this is nothing to make you jump out of your positions too soon.
All right. So I was like trying to pull it out of you without saying it myself. But basically, the risk of jumping in at this point is pretty low, relatively speaking, right?
You mean the risk of jumping out or jumping in right this moment?
Yeah, if you were to look, if you're saying, I can't time this thing, I'm really lousy at timing, I've never been any good at it, but I want to get involved. Is this such a terrible time to jump in?
Well, it depends on what you're buying and, what company. And then you have to look at the technicals of that company, because there's some stocks that are probably closer to a bottom than others. I mean, looking at the ETFs, I do see some more downside. So I don't disagree with your premise or your question, but I would, given the setup where we're at right now, I mean, we could see, I would just tell someone, just wait a couple more weeks, wait another month, because I think you're probably going to get a better entry point there.
Yeah, but perhaps. And but if you're like me and you're really not very good at timing, which I am not, I'm the first to admit my timing's not great. If you're a few days early or you're a few days late, either way, you're probably going to be okay, right?
Right. And in that scenario where you're less inclined to try and time things, I would say then focus your efforts more on picking the right stocks, because if you pick the right companies, it really doesn't matter, if you bought it 15%, 25%, 20% off the high, whatever. If you pick the right stocks, it's not going to matter in the long run.
Yeah, that is the point. And for those of you who are wary of timing, it might not be a bad entry point. Jordan, if I could just summarize what you're saying is, you probably can find a better entry point a couple of weeks down the road. But all things considered, if you were to get in now, it wouldn't be such a terrible thing, right?
Correct.
So, and that's a good thing. So that's good to know, and it gives you an idea of relative values, because I think for many of you out there, and for myself especially, figuring out what the real value is and when a good entry point is probably the hardest thing out there. I mean, when you think about it, right? It really is tough.
Right. I mean, it's hard because there's no, I mean, it's much of that is really subjective. So it's really hard. There's no right answer necessarily.
Yeah. And let's not forget, Jordan, you're a professional. So for you to go in and try to time it, you're probably going to have a better result than Joe Sixpack out there, or what I would call, Charles Chardonnay. Either one, right?
Right. But even with that said, I'll make an important point, which we're trying to get to, and that's my philosophy. Dating for this bull market, dating back since the COVID or even before that, I want to buy and hold. I mean, I'm working to get decent entry points, good entry points. But with that said, I want to buy and hold. I'm not trading in and out of things unless something has gone up so much and it's become too big as a percentage of the portfolio. Then you have to trim your gains. But that's really what you need to do in this bull market: buy and hold. And along the way, trim your positions that get too hot, and then redeploy that money into something else. So even though I'm trying to time this next low and help people that way, that's the only time I do timing. And once we buy something, that's it. Let the market do the work. The market will tell you if you need to sell it or trim it or not. But stick to trying to buy the best companies and then hold them over time, because that's how you're going to make the most money. Trying to trade in or out just doesn't make sense. And I've been saying, look, you either buy or you hold. Over the last month or two, it hasn't been time to buy yet, but right now we're very close, in my opinion, to getting to a time where you can buy at a more reasonable spot. So buy and hold. The time to buy is coming. Pay attention. My opinion, it's coming over the next couple weeks.
Yeah, and don't be afraid to take some money off the table as well. The old Wall Street saw, Jordan, you never go broke taking a profit. Take some profit off, but don't take perhaps too much, because you don't want to really kill your total returns because you didn't reinvest. And when you get those lopsided parts of your portfolio where you've gotten a 5 or 10-fold return, and now it's 40-50% of your portfolio, time to bail out. One thing, a lot of people have been asking us about, Jordan, private placements. And your opinion, do you need to be a professional to get into a private placement, or can anybody profit from it?
FSN Radio. It's all about what's next.
Financial Survival Network is brought to you today by Orin Resources, a junior exploration company with the appetite of a major. It's hot on the trail of the next globally significant discovery, creating enormous potential upside for you, the shareholder. Orin is one of the most aggressive exploration companies pursuing high-grade, scalable gold and copper deposits, and has a premier 7-project portfolio, including its 2 flagships, Committee Bay in the Arctic and Sombrero in Peru. Orin's unparalleled technical team and highly experienced management has a history of success in advancing and monetizing exploration assets. No wonder Orin's been called one of the best in the junior exploration sector. Orin trades on the TSX and the NYSE under AUG. To learn more, go to orinresources.com. That's AURYN resources.com.
The Financial Survival Network. It's all about what's next.
You need to be an accredited investor, so you need to be a high net worth investor. I started a elite service focusing on private placements, and we've done a couple actually. But I would tell people that you really need to be a high net worth accredited investor to get into those opportunities. And I look at those opportunities as these are a small portion of your portfolio where you're really looking to hit grand slams. You're looking for 10 baggers and more. So there's a lot more risk, but a lot more return potential. But I think the average person cannot handle that risk. They're not appropriate for the average person because there's too much risk involved. And so if that's not appropriate for you, I would just forget about those for a while because there's plenty of other stocks in the market that you can invest in and earn a decent, something with a 5x return potential, or even from time to time, a 10x return potential. So that's how I look at private placements.
All right. And I think that's a very reasonable way to look at them. It is for a more sophisticated investor for sure, because obviously there's intricacies to that market, right? And always can be difficult to get in and out. Your entrance and your exit can really be kind of messed up, or delayed, and that can work to your disadvantage in these private placements, right?
Absolutely. No, I mean, there's a lot of risk there. I've invested in some things in the last couple of years where, 1 or 2 things where they went down like 90%. I had a couple other things that looked like they were going to, they barely were going to survive. And, now because the market's turned, they're looking like they're going to perform fantastically. But that's just kind of how it goes. I mean, it's I don't want to say it's a total gamble, but it's more of a gamble compared to companies that are already listed. And that's basically how it is. It's appropriate for a small portion of a portfolio, and only a high net worth person can really handle that. I mean, if a private placements are 5 or 10% of their portfolio, it's not a big deal. But for someone who has a smaller portfolio, I mean, legally you can't do the private placements. But if you were in it, I mean, putting 20 or 30% of your money in that is just ill-advised in any respect. So I know it may hurt to not to be able to participate in them, but they're only appropriate for a certain investor and a certain person.
Agreed. You have to be very wary, and you got to be really smart, and you need some luck as well. And what I've noticed recently, though, and that's what really led me to believe that the market really got overvalued and out of balance, a lot of these private placements, Jordan, just took off to the moon. And they went public, they got publicly traded, and there are just so many companies out there in the sector have got cash, whereas a year ago they were all struggling. Only the highest quality, best capitalized, best sponsored junior miners really could raise funds back then, and even they had to pay at a premium. Now, just everybody you talk to, oh yeah, we just raised 5 million, 6 million, and it's like happy days are here again.
Yeah, no, I mean, just I know that I've passed on a few that have turned out to work really well, where, I have sources in the industry that give me advice, and, there's flaws with some of these things, but that doesn't matter. If they list at the right time, they can easily go to $1 if the market is hot enough, like it has been for the last couple months. So it's just a real gamble. And as you said, sometimes it can be difficult to sell. I mean, you can't always book your profits when you want to.
Yeah, exactly. And therefore you need to be careful, right?
Right. And going back to those who can't participate, you can still earn 5x, 10x returns. There's still a whole world out there.
Of course.
Of possibility.
Of course. And I didn't mean to imply otherwise. If you took it that way out there, please, for a person who's going to put a little bit of money in the market, there's plenty of options, and they're not going away. The numbers of options are increasing, because one thing we didn't talk about, Jordan, is the return or potential returns. When we look at these PEAs, preliminary economic assessments, and the final feasibility studies, they're all done. Most of them, the newer ones coming out now, not so much, but done at like $1,300, $1,400, $1,500 gold. Now we got 1,900 plus, and that makes a big difference. So the opportunities out there are going to be multiplying, and that's what we're seeing now.
Yes, because basically any project that has gold in the ground right now is probably economic on paper.
Yep, exactly. Unless they're someplace like, everything's submerged. And I was going to say, even in the Arctic Circle, though, that a lot of these projects are feasible that 6-8 months ago were like fantasy land, right?
Right. Well, yeah. I mean, it's basically almost anything you look at now, even all these optionality plays where you start putting the numbers into the studies, you start changing the gold price. It's like, wow, suddenly this thing's economic. I mean, it doesn't mean someone's going to buy it or it's going to get built, but that's basically how I look at it.
But
if you have a project, if you have a project with gold in it, it's probably economic right now. If you did a study, like almost any project.
And silver as well, right? Silver, their costs are, anywhere from $16 to $22 an ounce. We'll see how long it'll stay above 24, but in all likelihood, silver is probably going to go up with gold when that resumption occurs. What's your take on silver?
My take on silver, it's interesting. I have a lot to say on it. I mean, I think some of these stocks have really gotten way overheated, and I think people have to be really, really careful with silver. The vast majority of silver companies you're basically trading expectations, you're trading sentiment. So you have to be really careful when you're investing in these silver plays. Eric Sprott, he's investing in lots of these things, and he's driven performance in a lot of these names where just him mentioning it has spiked the stock. And also there's a lot of silver, not a lot, but there's a handful of silver companies where they have silver in the name, but then you look at their deposit and it's like, geez, this thing's only 30% silver. Like this should be, this is a base metals, company masquerading as a silver company. Right. So you see that a lot. And I would just caution people to be very careful with silver and silver juniors. You just be really careful. You have to be more aggressive about trimming your positions when there's big gains. I'm not saying I'm bearish or it's all going to end soon, but I do see a lot of gains ahead after this correction, but just be very careful because the vast majority of these silver companies and the projects they have, they're not going to end up being mines. Few of them will be bought. If they do get bought, it's going to be closer to the end of the cycle. So for all these reasons, you just have to understand that, I don't want to say a lot of these deposits or companies are not real, but they're not going to be building mines and delivering value that way. So just be very careful about silver and the silver. Well, I shouldn't say be careful about silver. Be careful just about the silver companies and these silver juniors.
Yeah, agreed. All right. So I think we covered enough for now, but we will definitely have you back on shortly and kind of review things, where they're at and where we're heading. Just tell us again, your site again, please.
thedailygold.com.
All right. And hey, what's the most compelling reason why someone should subscribe to it?
Oh, that's a great question.
Besides, it's all your work.
If you want to make money, you want to have some professional expertise help you, that's a reason to subscribe. I put out a lot of free content and information. Interviews like this one will be posted there. So check out all the free content first.
All right. Excellent. And hey, I will say it, since you don't want to, you get Jordan's insights and his vast experience and knowledge that really can help you, especially if you're not super experienced in the sector. Even if you are, you'll find companies in there that you didn't know about that really have great prospects. And I look at you, Jordan, what your work is kind of the sieve. You're filtering out all those companies that really aren't real companies. They're lifestyle companies or whatever, and hopefully leaving the gems that really have the best prospects.
Right, absolutely. But I will say, look, you can make money from time to time in those lifestyle companies. You just have to be aware of what you're owning.
Yeah, I just feel like the only person's lifestyle I care about is mine, and I don't want to. I'm not looking to help somebody live their life's dreams. If they're a shareholder and we're going to share pari passu and they're going to get the lion's share of the windfall, I'm okay with that. But as far as letting them travel first class and stay at the best hotels all over the world, ostensibly looking to raise money or whatever, that's not my thing. And I think most people would agree, because they have conflicted loyalties right off the bat. And when it comes to their interest or yours, they're generally going to pick their own. But that's a story for another day. Anyway, Jordan, it's great to have you back. thedailygold.com, and the link is in the show notes. Come visit us, financialsurvivalnetwork.com. Sign up for a free newsletter. Twitter feeds at Kerry Lutz. And Jordan, we'll be talking again real soon. Thanks so much for stopping by.
Thank you, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.